So what I'm going to do in this presentation, or it's actually in this series of presentations, is walk through forecasting a financial statement and using the example in your textbook in Chapter 9. I'm going to make 5 different videos, one for each of these tabs down here. The first one, AFN, stands for Additional Funds Needed, and in this video I'm going to show you how to calculate growth rates and sales using 3 different methods. The next sheet has to do with financial statement forecast. So we'll use the sales growth that we calculated on this sheet and the additional funds needed to forecast our financial statements for Microdrive for the next year. The third tab, the third worksheet that we'll work through is an alternative financing policy. The fourth is feedback, specifically financing feedback, and then finally the 5th year is the multi-year forecast. What we're going to do in later lectures then is use that multi-year forecast to calculate the free cash flows for the firm and the value of the firm today. I've chosen to use the Microdrive example in your textbook because this model was kind of developed with that company and with that example in mind. This model is not one that I normally use to forecast a financial statement, but I like it because it really shows off some of the important aspects of forecasting that you're not going to necessarily see in a normal forecasting spreadsheet. So what I'd like you to do for the assignment I'm going to give you in class is to go ahead and use this model that's provided. I'm actually going to fill in some of the information for you for the company I'm going to have you forecast, and so you can use this tutorial and the example in your textbook to work through that forecast for your assignment that's coming up. So what we're going to start off with is just calculating sales growth rates. And you see here that we have 5 years of sales for Microdrive, and that gives us 4 years of growth rates. To calculate the growth rate, what we're going to do is take this year's sales divided by last year's sales and subtract 1. So we see that we had a 23.1% growth rate in 2009. And then what we could do is grab this and pull it down, and what that gives us is 23.1% growth rate in 2009, negative 2.4% in 2010, 15.3% in 2011, and 5.3% in 2012. As you can see here, this is a graph. It's not a smooth growth rate, and that's not abnormal. For the example you're going to work for the assignment that'll be due in a few weeks, you're also going to see a non-smooth growth rate over time. The book gives 2 ways to use this information above. The first is the arithmetic average growth rate, and the second is the compound or the geometric annual growth rate. The difference between the two is that this just takes an average of the growth, the different growth rates for the different years. So this is equal to average, and then we go up here and we just select those 4 growth rates, and this tells us that we have an average growth rate of 10.3% for those 4 years. Sorry. The geometric growth rate is calculated a little differently. Your text gives some insight on this, and additionally, the notes provided on the page here also gives some information. Essentially, with the compound or the geometric annual growth rate, what we're doing is we're taking the first amount of sales for 2008 and the last amount of sales for 2012 and figuring out what the compounded growth rate would have to be every year to achieve that difference. So in here I'm putting an equals rate. The number of periods is 4 because we have 4 growth periods. Our payment is 0. Our present value, we'll put this in as a negative, otherwise it'll just give us an error, is going to be the sales for 2008. And then our future value is the sales for 2012. The additional items that they ask for, I'll just go through those. The type is just whether or not the sales happen at the beginning of the period, at the end. We assume that these quote-unquote payments or amounts occur at the end of the periods. And then the guess is not something we need for this because it's not a strange, abnormal cash flows. So this tells us we have an annual geometric growth rate of 9.9%. The problem with using this growth rate is because it's highly sensitive to the numbers, the beginning and the ending numbers, and really doesn't account for what happens in the middle. The arithmetic growth rate does have its own problems, and we'll talk about a couple of these, well, one of the important ones later on, but it is sensitive to outliers. So it is sensitive to this 15.3%, this 23%. If you look at all these numbers, none of them are really that close to the 9 or the 10% that we've calculated so far. The last one is to use a trend function. And this creates a regression, which we haven't gone through in class, but essentially it says it looks for a pattern in the numbers and in the growth rates to determine what the next year's growth will be. To do this, I'm going to actually delete the 2013. I intended to do that before because we may use this in the future for the multi-year as well. So I'm going to put in trend. The known y's in this case are actually going to be our sales amounts. So what this will do is actually project for future year what the sale amount will be. Our known x's are our years, 2008 to 2012. Then our new x's, we could put in multiple years here, but we only want to put in one. So we want to figure out next year's projection amount. I'm going to select this cell. We don't have anything in it yet, but we'll put next year in there when we're done with this. And then there's this constant. And you see here, if I put the comma, it gives us two options. That the constant is set to 1, which we don't want to do. That fixes the constant in the regression to 1. We want to let that float freely, and so we would either put true or just leave it blank. Now I'm going to put in my year, 2013, and that gives me a sales for 2013 of 3,243. Our implied growth rate then is equal to the forecasted year sales divided by our most recent year sales of 3,000 minus 1, or 8.1%. So that kind of makes sense. We saw a large amount of growth from this year to this year, then it went down a little bit, then a large amount of growth from this year to this year, and those higher growth rates were capturing those large increases in growth. What the trend does is it looks overall at this pattern and sees that the growth rate will likely be lower in the next year. The next, or the last example for calculating a growth rate is using the log function, or the log estimate. And to do this, we put in equals logest. Again, our known y's are our sales amount. Our known x's are our years. Again, it asks for constants and statistics. We're going to ignore those for now. We don't really need those. And so it tells us that it's 1 plus the growth rate is equal to 1.091. So as you can see here, what this does is that it calculates the y variable being the log of sales, and finding the slope of the log regression using this function. It's a smoother way of handling this kind of choppy sales growth. To find the growth rate here, we just take this and then subtract 1 to get 9.1%. Now I want to stop here because they make an important note down here about what they do with these estimates. These are all based on historic growth. It's not necessarily appropriate to use just historic growth in calculating the next year's growth or the growth for several years in the future. And that's because things change in the environment. To give you two examples, Apple has had extremely high growth over the past few years. Whether or not that can be continued is questionable. Certainly the market's been questioning it lately. Another good example is Research in Motion, which makes Blackberries. Their sales growth has been in a state of free fall in the past few years. They have not done well, and we expect them not to do well in the future. However, if you go back 5 or 6 or 7 or 8 or 9 years with Research in Motion, they had great sales growth. And if we had projected that out in the future, it would have been totally inappropriate and our results would have been horrible. So what we want to do is take these sales growth rates, historic sales growth rates, into consideration when we look at the firm, but also recognize the fact that things are changing, and we have to include that information. So what the managers of Microdrive has done have looked at their environment, and they forecasted a 10% growth in sales for the next year, and we'll include that down below. In the next section here we have additional the most recent financial statements, 2 years of financial statements, and I'll provide these in this manner for your assignment. Essentially, you can take a financial statement and pretty much just include them, put them in here, and I'll provide that for you. Down below, so we figured up a sales growth rate. Now we need to calculate the additional funds needed. What the additional funds needed are those additional funds necessary to purchase the resources necessary for growth. So for example, if I need to grow accounts receivable to add sales growth, or I need to increase my inventory to add sales growth, or I need to build a new building to add sales growth, those funds have to come from somewhere. Part of that will come from internally generated funds, and we've talked about that before. But a portion of those may need to be raised from investors, either through issuing new stock or, more likely, issuing new debt. So what we're going to do here is calculate the additional funds needed. To do that, we're going to take last year's sales, so that's SO, and that was $3,000. The forecasted sales growth rate was given to us by the management based on historic sales of 10%. The coming year sales are going to be equal to last year's sales multiplied by 1 plus the growth rate. Oh, sorry, it should be 1 plus the growth rate, or $3,300. Next is the change in sales. So change in sales is going to be equal to our projected sales minus our last year's sales. And then this next one is very important. Your textbook, I don't think, uses this terminology, but I want to take this opportunity to talk about the difference between operating assets and non-operating assets. Operating assets are assets used in the day-to-day operations of the firm. These would include things like some cash. Oops, didn't like that. Try it again. Cash. Accounts payable, accounts receivable, inventory, and net property, plant, and equipment. Non-operating assets are assets that the company holds, but aren't really necessary for day-to-day operations. The most common thing I see on a balance sheet would be falls into the category of short-term investments, and or these are known by the same thing, as these are the same thing known by two different names: marketable securities. Those are the most common non-operating assets you'll likely see on a balance sheet. Other things include long-term investments. usually investments held for sale. So these are investments the company's made, typically in other companies, but they're not used in day-to-day operations of the company. So for example, Pepsi-Cola owns bottling plants, but they own a portion of bottling plants. It's not used in the day-to-day operations of Pepsi-Cola. Pepsi-Cola makes syrup primarily, and they send that syrup to bottling plants, and then the bottling plants, which are independently owned, then combine the syrup with the carbonated water and put them in bottles. So those investments in bottling plants are really considered to be non-operating assets. They're not necessary for the day-to-day operations of what Pepsi does. The reason why short-term investments in marketable securities are considered to be non-operating assets is because these are considered to be excess liquidity. So these are funds that the company has, but the company really doesn't need to hold on to for operating purposes. Companies need a little bit of cash for their day-to-day operations. They need to be able to pay their employees. They need to pay the utility bills. They need petty cash to handle small little expenses. But by and large, not a lot of cash necessary for day-to-day operations. Excess cash then is usually held in investments so they can earn a return, because cash in the bank, usually just cash in a depository account, doesn't usually provide any return, while these provide a small amount of return. So the assets that must increase to support the increase in sales, these are operating assets, and I'll refer to them as operating assets as we move forward. We see in 2012 the company had $10 million in cash, plus $375 million in accounts receivable, plus $615 million in inventories, and then $1 billion in net property, plant, and equipment. Note that I did not include short-term investments, although it is just $0 in 2012, because it is a non-operating asset. It's not necessary for that asset to exist for operations. We get a total of $2,000 or $2 billion if you put that in millions of dollars for our assets necessary to support an increase in sales. So our required assets per dollar of sales are equal to 2,000 divided by 3,000, and that really should be in dollars, so I'm going to put that in. So our required assets per dollar of sales is 67 cents. The second item on here is last year's spontaneous liabilities. Note that it's L0, so it means last year's has already occurred. Spontaneous liabilities are those liabilities that occur spontaneously with an increase in sales. So we would expect accounts payable to increase with sales, especially if the company buys things on credit. They buy more inventory, they're going to buy it on credit, so that's going to increase with sales. Accruals, these would likely be things like accrued wages, where if I hire more employees so I can generate more sales, then that's going to result in higher amounts of accruals. So these are going to be equal to the accounts payable plus the accruals to get $200. So spontaneous liabilities per dollar of sales are going to be equal to 200 divided by 3,000, or 7 cents, or 0.0667 cents per dollar of sales. Next is our profit margin. That's denoted in your textbook as M, and that's equal to our net income divided by sales, or 3.77%. And then our payout ratio is equal to last year's dividends. So that's going to be $57 million divided by our net income for the year of $113 million, or 50.44%. So that's our payout ratio, which is the percentage of dividends as dividends as a percentage of net income. Our AFN, or additional funds needed calculation, is calculated as the required increase in assets, so what we have to generate in order to support our increase in sales, minus our spontaneous increase in liabilities, and then subtracting out from that our addition to retained earnings. So remember in class how we talked about the three ways that companies can increase their or can finance their sales growth, and those were either getting external financing through stock, external financing through debt, going to a bank or issuing bonds, or internally generated funds. What we see here is that this covers the internally generated funds. So we make money, we retain those earnings, and we reinvest them in the company. After that, what's left over are additional funds needed, and these are the dollars that we have to go out and get from investors. So what I'm going to do is calculate these numbers here, which this stands for the required increase in assets is equal to the required assets per dollar of sales multiplied by our increase in the dollar amount of sales, which is our change in sales right here, GSO. And so we're going to need to increase our assets by $200 or $200 million in order to fund our sales growth. Our spontaneous increase in liabilities that we expect to occur with our growth in sales will be equal to $0.0667 per dollar of sales multiplied by our change in sales of $300 or $20. And then finally, our addition to retained earnings will be equal to 1 plus the growth rate, 10%, multiplied by our initial year sales, multiplied by our profit margin, 2.77, oops, sorry about that, multiplied by our profit margin of 3.77%, multiplied by 1 minus the payout ratio. Okay, that gives us $61.60. So our additional funds needed are equal to $200 million minus 20 minus 6160, or $118.4 million. Just as a note, M multiplied by 1 minus the payout ratio, 1 minus the payout ratio is known as two things. The plowback ratio, or the retention rate. So this is the amount, or the percentage of the net income that's plowed back into or retained into the company for refinancing. So this is the amount we'll need to raise to support that sales growth increase. Down below, it talks a little bit about a self-supporting growth rate. And what the self-supporting growth rate is the maximum growth rate that can be attained without raising additional funds. And so this is the growth rate that forces additional funds needed equal to 0. And I'll demonstrate how to do this using the information provided down here. To find the sustainable growth rate with goal seek, first highlight cell B152. So what we're going to do is set this equal to 0. So I'm going to go out here to data, what if analysis, goal seek, and it says set cell B152 equal to 0. And then by changing cell, so what we want to know is what's the self-sustaining growth rate. So what the rate we want to change is our forecasted growth rate. And it tells us that the growth rate sorry about that. Do that over again. It tells us that our forecasted growth rate without adding in any additional funds would be 3.21%. The other way to calculate this is using this formula here, which is the profit margin. Multiplied by 1 minus payout ratio multiplied by last year's sales. And what that is doing is calculating the actual amount in 2012 that we can plow back into the company, the actual dollar amount that's going to be retained in the company, and saying, okay, that's all we get. We don't get to go out to our stockholders or to our bondholders to get additional funds. That's our numerator. Our denominator then is the funds that we need, the assets that we need for generating sales, $2,000, minus the amount of liabilities we have, our spontaneous liabilities actually, then minus our numerator up here. So you see that M times 1 minus the payout ratio times SO, that's what we have up here. I'm going to select that. That gives us 1,744. And here we can just calculate 56 divided by 1,744. That gives us 3.21%. Down here it talks a little bit about goal seek. It is a very useful function. We're going to use that, and then later on we're going to also use a scenario manager, which is a nice function to use in Excel too. The last item on this spreadsheet is excess capacity requirements. The idea with the additional funds needed is that we're using all of our required assets needed to support an increase in sales at their full capacity. That's not always the case. If you just look around the classroom, there's a lot of empty seats, some days more than others, and that's excess capacity for us. We could actually increase the amount of quote-unquote production in our classroom by filling those seats with additional students. So we have excess capacity in the classroom. We can also say that businesses do as well. We can say that they have excess capacity, they recognize the fact that they have excess capacity, and we can use that in our projections. So to do this, I'm going to fill out this form here. It asks what are the sales in 2012. There's $3,000. What are the forecasted sales for 2013? That's $3,300. Our total assets for 2012 are equal to $2,000. Our fixed assets for 2013 is going to be equal to H110, which is, our net plant and equipment for 2012. And then our original 2012, actually, let me make a correction here. This should say 2012 fixed assets. That's why I was lost a little bit there. So our fixed assets for 2012, and then our original fixed assets to sales ratio is equal to 1,000 divided by 3,000. The purpose for calculating this is to say this is the amount of fixed assets we needed to generate that amount of sales. So our fixed asset to sales ratio is 0.33%, or 33.33%. If the company goes back and says, but we had excess capacity, we only used 96% of our total capacity, so we still could grow a little bit more without adding additional fixed assets, then we can include that in our forecast. So the fixed assets that were actually needed during 2012 were equal to 0.96 multiplied to what we actually used, or $960 worth. So our excess fixed assets are equal to the amount we used minus the amount that were actually needed, or $40. So the operating assets divided by sales, if fixed assets had been operated at full capacity, would have been equal to total assets minus the excess. I want to put parentheses around that, divided by our sales for the year, or 65.33%. Our previously calculated additional funds needed were $118.4 million. Our revised amount would be equal to our 65.333 multiplied by our sales. Apologize. So to calculate the additional funds needed, using the revised ratio in the AFN calculation, we actually need to go through and calculate that AFN calculation again. So again, it's going to be equal to our assets divided by sales. So in this case, we're not going to use that 66%, we're going to use the 65.33%, multiplied by the sales amount of actual sales growth, which will be $300. Subtract out our spontaneous increase in liabilities, which are the LO asterisk divided by our sales for the year, multiplied by our sales growth rate, or excuse me, our growth rate in the dollar amount of sales, and then finally subtracting out our addition to retained earnings. And all I've done here is put in this amount, except for I'm using a different AO divided by SO. Oh, I didn't like that. Let me see where I made a mistake. Oh, here we go. Sorry about that. I just need to double check the calculation. So what I have here is our new percentage of fixed assets percentage of operating assets to sales of 65.333%. That's our first number, H198 here, multiplied by our increase in sales of $300. That's that's I-135, and then we subtract out the spontaneous liabilities per dollar of sales multiplied by the increase in the dollar of sales. So that's this function, this portion of the function here, I-139 multiplied by I-135. Then finally our last argument is, this long argument here is 1 plus the growth rate of 10% multiplied by the profit margin, I-132, multiplied by last year's sales here, multiplied by the profit margin of at I-140, multiplied by 1 minus the payout ratio, and that gives us additional funds needed of 114.40, which are a reduction based on the amount of capacity used would be $4 or $4 million. As it says down here, obviously the reduction in AFN would have been greater if there had been more excess capacity. Also, assuming fixed assets can be sold at book value, Microdrive could sell off 40 million in fixed assets to bring them down to the required level, then use the new fixed asset to sales ratio for the forecasted AFN, which really wouldn't be something a company would do, but we can account for that additional capacity in our future projection. And that's going to end our first presentation. I'll move on to the financial statement forecast for the next one.